Welcome to Morningstar. I'm Johanna, Englundh, and with me today is Eric Strand, and we're going to talk about gold and silver, two precious metals that haven't had such a precious return lately. Nice to have you here, Eric.
Thank you very much. Nice to be with you, Johanna.
And gold and silver, they're often seen as an inflation hedge, and inflation has, to say the least, soared since the start of the year. And 2022 really seemed like the perfect storm for both gold and silver. So in my perspective, I was a bit surprised when I found funds exposed to gold and silver amongst the worst performers in May. What are your thoughts on this?
Well, there are some different things to really think about here. And that's, first of all, many of us look at the price of gold or silver in dollars, which is correct, of course. But for us as investors in Sweden or Europe, it's actually the euro numbers that are interesting. And if we see 2022, gold has a new all-time in euro. It also has a 8% return in 5 months. So I would say gold has performed well, but not in dollars. And but however, if you look on 3 years, gold has performed like plus 35% in dollars and plus 45% in euro. So the euro has been weaker, but I mean 35 or 45% within 3 years, I would say it is a good return. But it doesn't really always come the month or the months that you really want to see it. So you have to somehow zoom out, look at the returns, and look at it in the currency that you where you're living.
All right. So for someone like yourself then, who follows the gold and silver market pretty closely, are you surprised at all by how gold and silver has performed during 2022?
Well, both yes and no. Of course, what we see is the long case where the money printing, the growing of debt in the world, that will drive the price of gold. However, we have seen a one-sided trade, everybody going long the US dollar. Because, I mean, you started to get some interest on your money and buying US treasuries, and everybody sees this. Everybody makes the same trade. The dollar goes up, of course. And for European investors, you get both 0.5% interest rate and the dollar strength that has been like 10-15%. So that has been a very easy trade. But what we think is that now everybody's long the same trade. So the next change will be when everybody has priced in the US rate hikes, and then they will start to think about, okay, now Europe has to start to rate some rate hikes as well. And then the professional investors, they will invest before that happens, and then they will start to sell dollars and go long euro. So it's just a little bit of timing. So for us, long term, nothing has changed. But we are in a very volatile market, and the currencies are very volatile. I mean, if we see that the US dollar and euro, the two largest currencies, can move 10-15% in 1 year, I mean, that should not normally happen. But so it's very special times. And as you said, we had a very weak May. We had minus 9.6% or something like that. And now before yesterday, we were plus 8% in June. So in half a month, we took that back. So it's a very volatile market, and it keeps on being volatile. And of course, now on Wednesday, we have the Fed announcement. So I think we will see more of the volatility.
Okay, so for all of these investors then that are invested in silver and gold, what would you like to say to them that might feel a bit disappointed with the returns in this market climate? Is it to zoom out or to look further ahead?
Well, I think we have two different cases. We have, I mean, either you invest in the case, and the case is long term. It's 10 years, 20 years, or 1,000 years, actually, if you look at gold. But it's a long-term case. But if you are a short-term trader, or if you want to sometimes sell a bit or buy a little bit more, then you will start to look for what is a good entry point. And of course, a good entry point is when the sentiment is low. And we have a very low sentiment in the gold and silver market. And what has happened is that retail has sold a lot of their positions, and that somebody's buying, and this happens on the COMEX, the commodity exchange in the US, and the commercials, the big banks have been buying. So in this downturn, they are the buyers because they want to have the positions when it goes the other way. And you can see that on charts when the commercial short positions are becoming lower and lower because they are buying long positions. That starts to become a really interesting point to invest. So to make a good investment, you should buy cheap. So this is, this volatility is good for short-term investors or somebody who wants to add, or when we go up, somebody maybe wants to sell a little bit, then the volatility is actually good. But I think in the long term, if you look at the 3-year or 10-year scale, it's almost like a straight line from the left corner to the right up corner. So I wouldn't be. It depends on the investor, of course, on how.
Yeah, and you have actually brought a chart that sort of shows this, the blue staples that are probably indicating that it might be a good entry point in silver.
Yeah, because short term, I think sentiment should be low, not high. I mean, as an investor, you feel that it's good when it's high because then the prices are up. But as a buyer, you want to buy cheap, and then it's good to buy when the sentiment is low, and also to add the commercial positions because they dictate a little bit the price in the short term. It doesn't change the price for long term, but short term. So it's a good entry point. And of course, for not just the commodities, but for the miners are in a very special situation because they have been, since the all-time high 2011, they have been in a bear market, and they didn't use their money in a good way, so they got a lot of criticism from their shareholders. And since then, they have really reduced their debt a lot. And this is very different to other sectors. They have just have more debt. I mean, in the US, it's the highest debt level for companies ever. And that always normally is the same time when the stock market crashes or something like that. So that's not a good sign. But in the precious metal mining sector, the debt has gone down a lot. And the free cash flow has never been so good. And the dividends are going up as well. So they are raising dividends. I think it's if gold and silver is interesting, the miners are even much more interesting as an investment at this point.
So there's more to it than just a spot price. You have a bigger picture that you can focus on.
Yes, and it's really important not to look at it in the US dollar, because in the US dollar, the prices have stood like flat or still for a long time. But as I said, on the 3-year scale, the returns are the same because the US were weaker the last 2 years before the last year. So it's a little bit how the currencies moves, because, I mean, gold is priced in dollars. And when the dollar goes up so much, it becomes more expensive or more valuable for European investors, but expensive to buy, or Asian investors. So they start to buy a little bit less, and that makes the price in dollars to stay flat or not go up so much. But it has gone up a lot in euro. And I mean, any investor that has owned gold in Europe, they are really happy to have this. And we can see that on our funds because we have positive returns for this year. Or the silver bullet fund we have it was minus 0.5% when we speak. And the precious green fund is plus some percentage, 5-6%. So for us, it has been it's a totally okay year. So not minus 15 or 20, but we see a lot of funds being at this time of the year. So sometimes the best years are not when you have plus 20%, but you are just 20% better than the broad index, broad market.
Yeah. So if we focus a little bit on silver that you mentioned, because silver behaves in a more volatile manner than gold, and it's also linked to the industry in a way that gold isn't. Does this not mean that silver cannot really act as an inflation hedge if it is so linked to the economy?
I would say silver is not such a good fear exposure. Fear when there is a trade war or war, that then gold goes up, but it always comes down. When we come to inflation, real inflation, I think silver is the better investment, because actually, are we going to get stagflation or really inflation? Because if we get an inflation, stocks will be good to own. Silver will be really good to own because it's good for the industry with the inflation in one way. If we get a stagflation and really recession, that's maybe not so good. But then I don't think we will get a recession and inflation at the same time. And the policymakers now They will have to choose to fight the recession or the inflation. And I think they will fight the recession because nobody can afford a long, bad recession. So soon they will blink. They will raise rates probably now up to 1%, 1.5%. But then I think they have talked a lot about 3.5%, 4%. I don't think they will get there because, I mean, the system will go down before that. So they will blink. And when they blink, the prices of gold in dollars will go up really, really a lot. So you have to position yourself before that. If you think they can raise rates up to 3.5%, 4%, well, that's another scenario. But I don't think they will be able to go there.
Okay. So what is the point that you mentioned this a little bit earlier about why you should maybe own gold and silver, but what's the point of owning gold or silver or both during times of inflation rather than, for example, stocks that simply have strong pricing power that can live through these inflation and just put the prices on the consumers?
I love that question because I had a podcast last week and I said, of course, our funds are very interesting in this climate of investment. And I got the questions, what else should we buy if not just gold, silver, or our funds, the AuAg funds? So I said companies with pricing power. So I think it fits well together. It's not one or the other, but if you're going to normal stocks, not our mining or gold, silver exposures, I think, as you say, companies with pricing power are the companies that will be the good place to be. But I would combine these two.
Okay. And on that note, thank you for sharing your thoughts, Eric.
Thank you, Johanna. Thanks.
And until next time, I've been Johanna Englundh for Morningstar.